Ladies and gentlemen, good morning and welcome to what is one of the many important conversations here in Paris at the global meeting of Women's Forum. I'm Karen Cho from CNBC, co-anchor of Squawk Box Europe. It is my pleasure to be here to take this opportunity to lead a conversation on a topic that impacts our future economies, the de-globalisation of financial markets. Just before we get started, a little bit of housekeeping. If you want to tweet about the panel, the conversation is #financial system. You can also use the handle for the global meeting, #WFGM17. Also, we will conduct a debate first up using about 30 plus minutes or so. We will offer some audience participation after that. A couple of quick questions. I will ask you to keep them very brief because we are running over already this morning. So if you do want to ask a question, please stand up and we will bring a microphone to you. And of course, the conversation you can continue on social media straight after. On that note, let me introduce our esteemed panel. Karine van Gennep, CEO of France ING. Andrea Ossel, President of Investment Bank UBS. And Michael Wood, CEO Rothschild Asset Management. Let me just set the scene for you. Over the past couple of years, de-globalisation has elevated political risks for financial markets. Bank of England Governor Mark Carney described Brexit as a unique example of de-globalisation. In the United States, President Trump's pledge to put America first has created fear around trade policies, offset by enthusiasm of a more attractive tax regime. Well, right here in Europe over the past month, anti-immigration sentiment expressed at the polls in Germany ushered in a far-right party to the Bundestag and tore down relative stability in the form of the Grand Coalition. Just this week in Spain, the country is reeling from the fallout of an illegal referendum vote in Catalonia. So let me kick it off on that note as we talk about Brexit and the stresses on the Eurozone. Karine, let me first ask you your thoughts on the implications of Brexit and European politics. Is it farewell to European financial integration? And ultimately, will the wave of financial protectionism impact economic growth?
Let's be very clear. Yes, protectionism impedes economic growth. We see it every day. We saw it in the past, we will see it in the future. And more so, consumer behavior is harmonizing, technology developments are harmonizing, competition is becoming global, so financial protectionism, deglobalization is hurting our economic growth. But I think the main question here is, why do we see this protectionism? Why do we see a Brexit? Why do we see the European elections, one after the other, showing more anti-European uprise? Why did we already see 10 years ago a French and a Dutch no to the European Constitution? I think what we see is a middle class adrift. It's no longer the man in the street. It's no longer a person without a job or an immigrant even. It's really a middle class.
So the who is relevant quite at this point in time. Who is voting for change?
It's really my neighbor, your brother, the people who are the middle class people and who have fear for their children's future. They might still have a job, but they have many uncertainties about globalization, immigration, digitalization. And if we don't address those concerns of our middle class, we will see those outcomes of these elections and those drive protectionism over and over again. And then it's just the beginning of deglobalization.
Michael Ween, here you're based on the other side of the pond in New York. What's the perspective from the other side about the ramifications of Brexit on financial integration?
Sure, and thank you again for the invitation. Initially, at first I want to apologize. Pardon pour moi l'enthousiasme naturel américain. I will try to keep it at a minimum. Yes, from the other side of the pond, I would think on the Brexit side, the consensus really comes down to the relationship that ends up happening, because we're still pretty unclear of the final outcome here, or even some of the plans for the final outcome, as we saw this week. But the relationship between the French and the British will really drive this. There's two likely outcomes, more than likely a status quo, where the Brits continue to operate throughout Eurozone as they are now, or there's a total separation. Not sure if there'll be anything gray in between those two, but the total separation, at least for the financial service sides that we're on, which is asset management, you could see the potential that the ability for an asset manager that's based in London now, that has the ability with the passport to be able to go throughout the Euroland, may have to move those employees somewhere, either in France or Frankfurt or Brussels or somewhere else, which creates a labor issue. Right? The labor freedom, the freedom of choosing where I went to work in Europe, regardless of country, that could change, which makes it very difficult for all geographies to access the best labor talent. That potentially could happen.
Andre, a scribbled note early on in the Brexit negotiation process from the UK government had the phrase, "have cake and eat it," indicating a win on the UK side. And I think it's fair to say the City of London is certainly not eating cake at this point, and the Tories at the conference in Manchester this week are not eating cake either. Why could Brexit be the trigger for financial markets to fragment across Europe?
Well, it obviously depends on the negotiation themselves. And if you ask any bank or any financial services company, they will tell you, well, tell us exactly what's going to happen. And at this point in time, nobody does know because the negotiation hasn't even started. So in general, as was said by Karine, I think the de-globalisation, protectionism, fragmentation is bad for the economy. It's bad for integration. And frankly, what in a way we're doing at the moment is saying London has a leadership in financial services, all the talent, all the ecosystem around it. But, and for example, Germany has a leadership in industrial production. Well, what we're going to do now is we're going to say we're going to produce cars in London and we're going to do financial services in Germany. It's the specialization is breaking down, and this moving from A to B is going to be quite complicated. I think going back to what was said in the previous panel, we go a lot on emotion. So the UK population, or rather the English population, has voted to leave for a number of reasons. Now it's like, okay, they leave, they can't have the cake and eat it too. So you're going to move financial services into Europe, and we forget that that's going to be bad for Europe overall, not only for the UK. But the emotions are taking over.
Liquidity is one of the prospects that really crop up here, that there is an impact if there's fragmentation on liquidity and the access to capital for certain economies. We're not used to having that conversation after what has been a global world and very low yields in many economies.
Well, I mean, if you go back to Europe, 20 years ago, and you were trying to do an equity capital raise or funding or whatever, you had to roadshow every capital, every stock exchange, every place. Liquidity was fragmented. It was not very efficient. Gradually, we've changed that. What we're doing now is, to a certain extent, go back to where we were. Just think about it, of any company wanted to be listed on a stock exchange. Now, it's you break that liquidity down in 2, in 3, in 4. Each stock exchange does not have critical mass for that company to be traded efficiently. And if you then put borders on the free flow of capital, you're going to have further inefficiency. There are a lot of statistics going around, but for example, just the clearing of a euro, moving from LCH to a European location or another exchange, means a very significant increase in cost. So yes, the UK can't have a cake and eat it too from the perspective of the Europeans. However, is fragmenting liquidity and is changing these things in the best interest of Europe. And how do you balance those two things?
What we also see, let's put it in a bit of a broader perspective, is at the same time that we see financial disintegration, we have challenges that no European country can face alone, whether it's sustainability, immigration, unemployment. So we need further integration in Europe. And actually, both the Brexit and the election of Trump are blessings in disguise for Europe, because it shows the need that we need further European integration. And it has also changed many of the discussions that we need closer cooperation, that we need closer European visions, aligned visions between the different countries to move forward.
Michael, do you think financial integration is even going to happen in Europe when you read the politics and you know what the protest vote looks like in America, for instance. You read the tea leaves in Europe. Do you think integration is even a prospect that we can consider over the next couple of years?
Well, we hope so, because it definitely helps commerce, right, across the board. With exactly the same point, without allowing investment opportunities for ability of transparency of what we're investing in, how we're investing, the markets we can get into, bringing that back is a difficult challenge for anybody. Once the global, the integrated global society that we currently have, you start to fragment that in a very large European market, it could have implications in other areas such as Asia, doubtful in North America. You already have such a integrated society there, separation of political side, but we hope that the integration continues here, that it doesn't become separated, and that a Brexit impact, whatever that may mean, or even a Grexit potential in the future, whatever that could mean, we hope that the solution is simple and it's quick.
Karen, before we move on, I want to ask you about the implications for jobs, because when we talk about economies and economic growth, it all boils down to what job prospects many people have across economies. And I think right here in France, you saw at the election earlier in the year that people voted for change. They were concerned about their job prospects and de-globalisation, technology disrupting jobs, but ultimately they put their confidence in Macron, thinking that there will be job prospects. You say to many people globally that people need to think about their psychology around employment prospects, that life is changing. You're not just in a job for life these days.
Yeah, that's correct. The fear of losing your job, we should put in a different context. You don't have a job for life anymore. 40 years with the same company, that's history. So we all need to prepare to change our profession 2-3 times in a career. But that also means we need to change our perspective of those people who lose their jobs. Because now we often put a stamp on their forehead, say, loser, you're without a job. We have to change that perspective as a neighbor, as an employer. It is somebody who's preparing for the next phase in their career. It's somebody in transition. If we change that perspective, then it will become, it will never be easy, then it will become different if you lose your job and you prepare for the next one.
Do you want to weigh in on that?
Yes, I think it's absolutely right. I mean, if we look at all the digitization or technology taking over, you know, every bank will tell you there are tens of thousands of jobs that will be lost. But the relevant part is over what period of time, and how do you transition your workforce from doing job A, which in theory was lower value added, to job B, which is more value added, and therefore you get in a more productive environment that then creates more jobs overall, but you have just transitioned people from a job to another, and that is quite complicated. But if it's done over time, and if people have a plan to execute that as robots take over, I mean, at UBS we now have 3 or 4 robots taking over for some of our tech and operations reconciliations, and people are all nervous, well, where is that going to take us? Well, what it's taking is that you can retrain and do a higher value-added job as opposed to doing something manual that now really a robot can do for you.
Let's push on and talk about developing economies, because often we can look at the world through the prism of the United States or Europe or developing markets, but how could financial protectionism that we've been talking about impact financial stability in developing economies? And the question is around capital-constrained countries. But at this point in time, it seems like we have the very opposite, not capital-constrained countries, but ones that are battling a lot of liquidity coming into the markets. Michael?
Sure. What we're talking about here is the law of comparative advantage, which says that 2 or more countries can actually benefit each other in terms of their productivity when they trade, when they freely trade. Right? And this can be really looked at as the last 3-4 decades. This is really the reason why inflation has remained relatively low in developed countries. Your standard of living in non-developed countries has enhanced significantly over that. If all of a sudden that starts to change and you impede or you protect there on a manufacturing side, you know, your rise in productivity will definitely decrease, right? Because your net importers, such as the U.S., are going to have higher costs. Your next exporters, such as China, could see, of course, higher unemployment because they're not exporting as much and they're mostly protecting and being internal, right? The worst case scenario that you could see here with this would be a slowing down of global economies, local economies, and social unrest, which nobody would want to see. On an investing side, on the asset management basis, the fear there would be a lack of investment opportunities. As we were talking about earlier, if you start to impede capital flow, it also impedes investment opportunities. And when you're talking about pension funds or retirement plans, doesn't matter throughout the globe, the responsibility of those stewards of those plans for all those retirees that they are responsible for, they do not have as many investment opportunities potentially to be able to get that flow of capital, investment returns, to be able to satisfy the retirement requirement income to those pensioners. That's a big concern.
Is that going to be as relevant, though? Because interest rates are apparently going up. If you listen to the Fed and some of the more hawkish members, rates are going up. So therefore, aren't pension funds going to have an easier time over the next 10 years?
Well, the question is, how much do they go up, right? And you look traditionally, of course, you go back to the 80s, early 80s, you had double-digit rates. You've continued to come down since then. A little bit of a blip in the mid-90s. The time frame now on a global scale with hopefully an integrated global economy, can interest rates really get even close to a traditional basis? And we would say no. Yes, they will probably go higher as you start to see a little bit more inflation, you start to see a little bit more global growth, which we are seeing now, but we do not see a dramatic change of a point to 2 points. Quarter point, half a point here and there, absolutely, but nothing like it used to be.
Karin, come in on the point on the impact of financial protectionism on developing economies, because I can't tell you the amount of times I have a conversation with someone from a developing market and they say, well, there's no impact of a stock market sell-off on my country because, you know, people make their judgments on different metrics when it comes to our country. What do you make of some of the reports? The McKinsey Global Institute, for instance, says there's been a 65% fall in gross cross-border capital flows since 2007, the financial crisis. So it tells you that money is constrained in terms of the homes it's going to. Do you think developing economies naturally miss out if there's financial protectionism?
Yes, I do. What you see happening is in a multilateral system that we have is that some of the countries miss out and some of the countries really benefit. And of course we see also free flow of capital. It sometimes creates financial bubbles. So there need to be rules, there needs to be some kind of system and regulations. But I think one of the most underestimated opportunities for developing countries, and especially between neighboring countries, is trade facilitation. Trade facilitation means it becomes easier to trade between neighboring countries, and the WTO just showed this summer there's actually a 14% possibility, which is $1 trillion in trade possible between the poorest countries in the world if we do more trade facilitation. So that's really something that will make an immediate impact.
Andre, from your perspective?
I totally agree, and I think that, well, there is a lot, what I would add is that, well, there is a lot of evidence that free trade is good for the economy and is good for global. Financial services and free flow of funds needs to be thought about quite thoughtfully. If you look back to the 90s in Asia, in Mexico, in Russia, too fast opening of capital flows can have negative effect and create bubbles. Having said that, over the long term and in general, an open economy, an open way of having capital flows across economies is positive. And I think there is a lot of debate around, is globalization good or bad? I think globalization is good. What we do with the benefits of globalization is not as good as it should be because it has divided society. But I think globalization in general brings economic growth, and economic growth gives more jobs, gives more richness, and therefore the question is how you divide that among the population. And I think at the moment what we hear clear from the population is that, well, hang on, it went only to a small fringe of society, it didn't go to everybody, I didn't benefit at all, so let me try what was there before. But what was there before did not work very well.
I do wonder whether it will come down to the efficiency of government in many of these developing countries. I mean, Michael, you raised the example of China, but to me, I'm less concerned about China because it's moving towards high tech, higher margins, a stronger economic model than the lowest cost producer in the room. So I wonder whether the next phase of what we're dealing with, if capital is constrained, we have higher rates, countries like China might be better off, and it might be other less developed economies that are still relying on cost advantage that will be constrained over the next decade.
Yes, and they are opening their markets up a bit, most especially on the financial side, where they're allowing companies to come in. There's no doubt China will benefit from that. The One Belt, One Road initiative in China, which is hopefully going to involve much trade, many companies, many different industries that would be involved, many different countries as well, as the One Belt, One Road goes through Kazakhstan and other countries in the area. So I would agree with you that the benefit definitely is there from China. Other countries that aren't that developed yet, we need to help. We need to continue to help their financial systems, help them to understand how to connect, how to be freely connected without constraints, without tariffs, without barriers. So I would agree with you that China probably benefits from this. The interest rate cycle is definitely on the upspring. We should see that, not just in the U.S. Starting first, but you're starting to get some talk here as well in Europe. So yes, I would agree.
Well, this is Women's Forum, and I think the challenges we've been talking about are human issues, but specifically let's drill down into the impact for women. Andrea, first up, how does a de-globalised financial system affect women differently than men?
I think, in my opinion, once you start fragmenting, you start deglobalizing, you start creating protectionism, you prevent the free flow of capital and of people. You have a number of consequences. First of all, just on education, it's a lot more difficult for women who may not get the right education in their countries to move over and get the right education somewhere else. Same thing with getting employed. They may not get employed in their countries for a number of biases. Now, they can't free flow to a place where they can get their talent recognized. From a capital standpoint, every time there is a full availability of capital, which in a globalized world always occurs, there is no real social bias or gender bias or bias on any court. People review the project, it makes sense, the person can do it, you invest. If you start fragmenting the availability of capital, then there will be bias keeping in. There is less to go around, and people will take a view. And usually in a number of economies, you will have some unconscious bias, such as, I don't know, a woman is less likely than a man to be a successful entrepreneur, which doesn't make any sense. But in some societies, it may be making sense. In the 80s, in Japan, a woman could not get a job in a Japanese bank. They could get a job in an international bank in Japan. And now you have some successful women who went up through that, and we have more professionals in the industry. So I do think that when you put a global standard and when you free flow, you allow these biases to get ironed out by international perspective to come in, international capital to come in, or people to be able to come out and go in other places. Once you fragment it, you take that away, and usually minorities or all the biases kick in, and that's not good in general.
It suggests globalization has been such a success for women already, but where are the women in some of the big top performing sectors of the past decade? Mining, gas, oil, new sector technology. Women are still underrepresented in those particular areas of the economy.
Yes, they are, and you haven't mentioned investment banks. Which we should.
I did say booming.
Yes, they are, and I think that the key challenge is how do you get this bias to disagree and our workforce to actually represent at all level the split of society, gender being one of them. And people are trying very hard, or not very hard, depending on the perspective, but I think that the real challenge that we all find is if you have a population of 10,000 people and 80% are male, for example, moving that percentage from 20% to 50% it's almost generational. And in some sectors, the talent is not even there. So it takes a long time. That gives a lot of excuses to people to just say, well, it takes a long time, not under my watch, who cares? Or you try to jam it top down and make it happen with quotas, with incentives, etc. And then that can also have negative consequences, because I have never seen anybody who wants to be promoted, oh, well, you don't really deserve it, but because of your gender or your race or whatever, I'm going to give you that opportunity. So I do think it takes time, and the real challenge, I don't think people, especially at the top of organization, debate with a necessity for this to happen. We're all struggling on, so, okay, so how are we going to get that done, and how are we going to show progress within a period of time that is visible as opposed to a decade or very long periods of time?
Karine?
Yes, I'm going to be a bit more activist than you are.
Yes.
So yes, first of all, we know going backwards to protectionism, you get the insiders over the outsiders. Women are more often outsiders than men. Second, we need more diversity in teams because we know they perform better. So we all have a responsibility, whether it's a corporate or personal responsibility, to actually get more diversity in our teams. So the question is, what are we doing about it? Not waiting 200 years before we get equality, not waiting before this one female talent, and there are many out there. There are 1,000 female talents here, so never say again, there are no women to recruit from. Sorry. But let me own up to my unconscious bias, because I have one as well. I tend to recruit, promote, prefer to coach women who are like me, but 5 years junior. So I tend to recruit women in their late 30s with small children who are on their way up. So if I have an unconscious bias, you will have one as well. And if we don't break that vicious circle, if I don't stop recruiting late 30 women and you don't stop recruiting early 40 men, we won't get to diverse teams.
I would agree. So I would agree with that, but if you start with an example, so unless you have role models in an organization, and we're trying to do that, and in fact in my executive committee for the investment bank, I got to 40 or 45%, depending how you count, which is women. But the issue we find the most is when people start in this career, so all the feeders into the organization, they don't have a role model. They say, well, hang on, it's quite difficult for me to get to a job because it's a male-dominated environment.
No, but sorry.
And we lose them all the way. So at the moment, we are actually struggling to convince them that actually there is a key opportunity, and we keep on losing a higher percentage of women than we do on men at the mid-rank level place. So that's where we're trying to change the dynamic. I mean, I'm not saying it is the right thing, but I'm just saying that this is a fact at the moment.
But I really think it's too easy to say these women don't have a role model and therefore they quit. So then you become the role model. So then you go for it.
I understand, and this is what we're trying to do, but then it's not my opinion, it's the opinion of the women we discuss this issue with, where when we say, well, why are your colleagues leaving? We're investing so much and we're trying to do all these things. So is there anything that we have done that is not working? The number one answers we get is, yes, that's fine. You can be a role model, you may care, but you're not a woman. And therefore, I do not see enough people I can learn from, and I am not that convinced I can get to that position. So then it takes you to, how do you increase significantly and fast the number of women in the leadership team quickly? The problem is, contrary to popular belief, every bank is trying to do that. And it's quite difficult to hire them. If I can have somebody who can be, or who wants to be in the CFO of the investment bank tomorrow, we have the spot open. I'll put it up for all of you.
Yeah.
Ladies.
Michael, jump in here.
Should I jump in? Okay. Would you? Okay. Yes, for sure.
You can be the role model.
Yes, okay, there we go. The shining example that you're talking about, and we're talking about deglobalization, not just industry by industry, but also country by country. And we need to think both locally and globally here. The shining example, we totally agree. If you're a 20-year-old, 30-year-old woman and you want that example, whether it's a company you're joining or it's a country that you're trying to even survive in, right? That in a deglobalized area, think about those emerging countries, right? Where your great shining examples of Merkel and May and Lagarde and many others. You could see an example of deglobalization that all of a sudden, how does their influence continue to go global? How is anybody going to know if you're deglobalized that these things are possible for me as a woman, for me in my career, right? And the biggest thing that we see as a potential issue is people also want to be understood, right? They want to know that other people that are higher, that I want to become like, understand me and have the same feelings that I have. They understand what I'm going through. And you're right, if it's only men at the top, then there's not going to be that feeling. Everything that we're talking about today has to start at the top. We have to change the top so that the next generation feels like I can be there as well. I can see it, I can touch it, I can feel it, I can taste it, and I'm going to get there.
Michael, you also raised a good point about the Saudis wanting access to international markets,
Yeah.
therefore granting the right to drive, finally,
Yes.
for women, which I think is a great example of open markets. I did promise to take a question. We're almost out of time, but does anyone want to stand up, and do you have a particularly pressing question that you would like to ask our panel? We will bring a microphone and take one question if there is anyone in particular who wants to ask one. This is one of those be brave moments, stand up, dare to ask a question. Is there anyone who wants to engage with the panel? Oh, over here. We will try and bring a microphone down to you.
Hi, thanks very much. A fabulous debate there. Just a quick question is, so what is your tip to the fastest way to increase more women at the top? We've all said we need to do it. So what are your individual tips for the fastest way to get change? Thank you.
Karine?
I guess that's to me, yeah. You have to do a couple of things. First of all, you have to make sure that for every open position, you always ask for one minority in the top 3. That can be a woman, it can be if you're an engineering company, a non-engineer, but make sure that the people who are recruiting widen their view. That's one. Secondly, there are specific functions where you can just demand to have either a woman or a non-engineer or whatever. You say for this specific function, I ask the recruiting firm or my own HR to find a woman. 3, when you do a large reorganization and you're going to reconstruct the teams, you can easily set some targets and saying, okay, 2 out of your 5 or 7 direct reports have to be female. And you're going to find them no matter what. If you do that, you can gradually, within 2 or 3 years, you can renew the leadership and you can end up at 30% female leadership. The thing you have to do is, you have to talk about it afterwards. When you do it, you do it. Don't promote it in the beginning, because then you get all those discussions about, oh, she's only there because she's a woman. You just make it happen, you talk to your direct report, you talk to your HR, and you go for it. And then after 2 or 3 years, you have a fully renewed leadership with females in it. And in France, by the way, 4 out of the 7, including myself, are female.
Thank you for the question. Thank you for the response. We're out of time, so just a quick one to our panelists before we wrap up. 10 seconds and a tweet if you want your phones ready to tweet this out. How will you take action and dare to lead? Michael?
Yes, so our research shows that 88% of women investors want to invest in a socially responsible, impactful investment, which is ESG, environmental, social, and governance type of investment. Right? In America, we round things up. 88 to me sounds like 100%. Really are interested in this. So what we're trying to do is we're partnering with a company in Los Angeles called Angeles Wealth Management, and we're striving to create an appropriate, risk-adjusted vehicle that is focused on the United Nations Women Empowerment Principles, that public companies, CEOs, and boards sign and adhere to these principles. And that will be our beginning point to find the right companies that are doing the right things for women in an investment vehicle for the world.
Michael, thank you. Karine, 10 seconds. How will you take action and dare to lead?
Well, first of all, I will continue and strengthen my own diversity actions, but I think the main pledge here is I will challenge every man I meet today, tomorrow, and the rest of the year on what kind of role they're taking in driving diversity.
Andrea?
I will continue to find the right way to transform our workforce, especially at the leadership level, because of a role model impact, and continue to move that both top down and bottom up.
Ladies and gentlemen, terrific discussion. Thank you very much. Andrea, Karine, and Michael, appreciate your time.